All right, everybody, welcome back to the Traderline Conference. We're super excited to have our second speaker, Brian Shannon, the CEO of Alpha Trends, one of my favorite traders to talk to and someone who I've learned an incredible amount from. So, Brian, thank you so much for being a part of this once again, and welcome.
Hey, thanks, Richard. Thanks for putting this on. We've got a great group of speakers here this weekend and next weekend. And I think there's going to be a lot of common threads, obviously, because you've chosen people who are successful in their fields. And, one thing I want to talk about today is really kind of time frame. I think that my time frame tends to be a little bit shorter than a lot of people. And uh, that is working well in this market environment in particular. So let's share the screen and get started. I've got a brief PowerPoint here, and it's not, believe it or not, about the anchored volume weighted average price. I'm going to save some of that good stuff for when that book comes out here later in the year, which is a true thing that's actually happening.
Looking forward to it.
So, lessons of the bear market. Is it over, and should we care? So I try to make it a little bit interesting of a title, I guess, kind of a clickbait type of title. That we're still in the throes of the decline. That's we've seen several bounces. I've put up a chart of the S&P 500 that showed four bounces that were, I think, 8%, 11%, 10%, and 9%, something like that. So, but the sum of the declines is still greater than the sum of the rallies. And that's the way it is, of course, in a downtrend. That's, in fact, the definition of the downtrend: lower highs and lower lows. So is the bear market over? That's anyone's guess. Truthfully, I'm not here to answer that question. I honestly don't care. It's not my job to try to pick the bottom and say that was the end of the market decline. The way I look at it is anytime we have declined down to a significant level, like we have, let's say, in the S&P 500 at the key volume weighted average price, then we take a look at that level on shorter term time frames and see what's happening under the surface. As the market starts to firm up a little bit, and we're going to talk a lot about the 5-day moving average, and that 5-day moving average starts to flatten out, then I start to see, I'm starting to see in my charts prior to that there's more long setups, and then the market starts to firm up a little bit, and then the market makes a higher high above a rising 5-day moving average. To me, that's when I'm bullish. So I'm wearing two different hats, and we always have to. If you're a trader, you have to say, here's the time frame that I'm trading. The trend that I'm trading right now is a swing trade time frame, but I know we're still within the confines of an overall bear market. And maybe this is the low, but it's not my job to try to pick the low. Instead, I'm looking at it and saying, I'm going to buy some stocks. If these stocks continue to go higher and I don't get stopped out of them, then I'll continue to hold them. My job is to listen to the message of the market and listen to the message of the market on multiple time frames. So again, it's recognize that big picture. And as Patrick was pointing out, and a lot, as I like to say as well, when we're in a downtrend overall, if we see a strong stock, we still want to trade that strong stock, but maybe with lesser shares, maybe a little bit tighter stock, just reduce risk overall. Most of the stocks that I've been trading have been, what I consider a B, half risk unit, basically, is what I'm willing to risk in this environment for longs. I've had some good longs, I've had some good shorts, but it's really been a choppy year. It's easy to look at the market and go, look at, these beautiful declines. We're down 70, 80, 90% in some of these previous winners: Roku, PayPal, Zoom, Peloton. Your list is as long as my leg. And both of them put together probably. But the point is, looking at those stocks and downtrends, it's easy to say, wouldn't it have been great to just short up there and still be short? And I shorted a lot of those stocks at much higher prices, but I've also covered them. And, the short side is just so much more difficult to hold for me. And, I hear a lot of other people say the same thing. In fact, Stan Druckenmiller said, it's more difficult to trade on the short side. And, he's the guy who broke the Bank of England. So here we have, a difficult market environment. And for most people, if you can just survive in this market, not give up all your money, and for when it is healthier again, then you're going to be in a much better position to capitalize because you have your capital available, and your mental psychology is ready. So for me, this market's been a grind. I'm up on the year. I've been up pretty much all year. It's not up significant, but it's up, and it's been, as I say, a grind. So the point is, whether we've made a low or not really doesn't matter to me as a trader. People, prior to the market entering a downtrend, people would ask me, Brian, what are you going to do when you go to a bear market? What's going to change? And my answer was always, honestly, nothing. Nothing's going to change. I'm going to continue to listen to the message of the market. I'm going to look for trend alignment on multiple time frames. So if we're in a downtrend and then we see the rally, the short-term rally that peters out and starts to decline again, then I'm going to get short. But I'm not going to fight the near-term trend. So we always hear people say, short the rip. Well, we're in the middle of one of these rips right now, but we don't know if this rip is going to stall out at 7%, 10%, 20%, or it's just going to keep going. So as you know, Richard, you were there in Las Vegas. The title of my talk there was don't buy the dip, don't buy the breakout, don't short the rip, and don't short the breakdown. So what do you do, right? And we'll talk about that as well. It's about looking inside underneath the surface at shorter term time frames, basically taking the daily chart and your weekly chart and taking them on a higher resolution by looking at it basically under a microscope. So if we're looking at a 65-minute time frame, there's 6 equal candles per day. So it's basically taking the daily time frame and putting it under a 6 times magnification. If we look at a 30-minute time frame, well, there's 13 30-minute candles per day. So we're looking at it 13 times resolution, etc. So the key that, I know who I am. And I've just identified that. I'm a swing trader. I look for trends that will last. I'll do some day trading if that's what the market gives me. But my goal is that I want to buy a stock, and if I'm right in it, to let the market tell me to continue to hold it. It's up to the market whether I can swing trade it. It's up to the market whether I can hold it for a longer period of time. I don't look at a stock and say, I'm going to hold this for X days or X percent. It's, I have an idea of what I think the stock should do, is capable of doing. But as always, risk management is job number one. So who are you in the markets? There's so much noise out there. People will say that's the bottom. And the loudest mouths out there will really kind of throw you off your game at times by being loud and showing their confidence. I even to this day, Richard, I find myself sometimes I just have to turn certain people off because I look at what they're saying and the passion with which they say it, the conviction with what they say about a stock. And I start to go, what does this person know? And I look at the chart and I go, this is a piece of shit. What are they talking about? I got to just tune this crap out and just really listen to the message of the market. We want to be aware, to me, fundamentals and technicals are kind of the same thing. And here's what I mean by that, in that they're just a reason to look at the stock. The fundamentals, to me, I want to know all the things that William O'Neill taught us, the things that I learned, 30 years ago. I want to know if the company's selling more stuff, whatever that stuff is. It's good to see the revenues are increasing. I want to see more earnings, that they're making more money selling that stuff, whatever it is. But not because I care about the company. I mean, it's nice, good, we're voting for the company. I don't view myself as, hey, I'm partners with this company. I know what I am. I'm a trader. I'm taking advantage of price movement. But when it comes to fundamentals, I know that there are big institutions that are going to commit, tens of millions of shares, hundreds of millions of dollars, billions of dollars to a single stock. And those guys, if I can figure out what they base their decisions on, higher revenues, higher earnings, better margins, and that sort of thing, if I understand what makes them tick, that, fundamentally, then I know that if I see a stock with a good chart, that I've got this institutional base that's most likely going to be there to buy the dips. But if they're not there to buy the dips and the stock falls apart, it tells me something's changed that they know about, and I'm no longer interested. So it's just the same as a pullback to a 50-day moving average, to an anchored VWAP, to a Fibonacci level. Those are levels of interest. That's why I call them levels of interest. They're not support until they bounce from there. So we look at them and say, here's a level of interest. Why do I care about this 50-day moving average? It's not because there's any magic to the 50-day moving average. I've spoken, several times about we really should be looking at a 63-day moving average because there's 252 trading days in a year, 63 per quarter. And the market, we have a big event every 3 months, every 63 market days, which is earnings. Instead, for whatever reason, the 50-day moving average has been popularized and, self-reinforced because we have all these people who look at it, who make decisions around that. So I want to look at it and say, hey, we're pulling back to the 50-day moving average. I'm not going to buy because we're at the 50-day moving average. I'm going to look at it and say, what happens at the 50-day moving average? Well, a lot of times big institutions that have a lot of shares will support their stock there. They don't want to see it fall apart. So on the way from 20 to 30, they might have sold, 500,000 of their 5 million shares. As it pulls back to the 50-day moving average at $26 per share, maybe they're going to stick in a bid for 200,000 shares just to support the stock so that 4.5 million shares don't fall apart. And they know that if they put their bids in there, well, what's going to happen? It's going to make the short sellers think, hey, there's a big bidder in here. I shouldn't be shorting. In fact, maybe I should start to cover some of my shorts. And then other people on the sidelines, like myself, who see this action occur on a shorter term time frame, I look to that 50-day moving average and I look at a shorter term time frame and I see it moving back and forth for the last couple of days. I see the 5-day moving average flattening out and I say, here's a potential candidate for trend alignment. Now I'm interested in this stock. Oh yeah, plus they have great revenue and earnings and all the reasons that people are interested in stocks. It's about, a lot of people spend too much time, looking for a cup and handle or a head and shoulders instead of saying, what does a cup and handle represent? It represents a stock that pulled back. It rallied to a level of resistance that it hit. It pulled back again, but this time the buyers were more aggressive. Instead of pulling back to 20, it pulled back to 25. The buyers didn't wait for a pullback all the way to 25 before they stuck in their bids and said, I want this stock here and now. I'm willing to pay up for it. So they're becoming more aggressive price-wise. And then if we've got an 8-week cup and a 3-week handle and it bangs up against that level where that, let's say it's 30 at that peak where it fell back from previously, well, what do we see? We see more repeated tests of that supply. And as we see, any time a level of support or resistance is tested more frequently, the more likely it is to fail to hold. So in the case of what's been resistance at 30, we came up once, we were rejected. We pulled back to 25, came up and hit it, we were rejected, pulled back this time to 27, and then came up to that 30. And we're working through that supply at $30 per share. So maybe there was 1 million shares off of the first time. The second hit, there was 700,000 left, and on the third hit there were 200,000 left, and that quickly gets chewed through. Then the shorts start to cover, longs come in on the sidelines, etc. So it's just all about trying to understand what's the psychology of what's happening, not just being a monkey who can look at patterns. That's one of the things I dislike about technical analysis is kind of the patterns, and in particular, candlestick formations, the 3 crows, this and that. It's good to know what they represent, but just, memorization of here's what this candle formation is, instead of looking at those candles on a shorter term time frame and watching the supply and demand, watching that battle underneath the surface and try to see where do we have evidence that the buyers emerge victorious or that the sellers are able to defend price action that's not able to break out, and then we see a failed move and the stock breaks down quickly. That's what's most important about technical analysis that people don't get. But they just look at textbooks and say, okay, I just have to remember these 5 patterns. That's great. I want to see bigger volume. But what does bigger volume represent? The big volume doesn't really occur until turning points. Volume expands in the direction of the trend, peaks at turning points, and diminishes on the pullbacks. So a lot of times, people who wait for the volume on a breakout, they're going to be late because they're looking at the stock breaking out and they don't trust it because the volume's not there yet. And you've got to learn to trust price action. So again, that's who I am in the markets. if you're an investor, you've probably got no business listening to me. Some people will try to argue with me and say, yeah, but interest rates and this and you know what the Boris Johnson's doing over. Give me a break. I mean, just got nothing to do with what I do in the market, and it's somewhat of a lazy approach as well because I don't have to listen to all that stuff. But it's that's what the cynic might say. But for me, it's the realistic is that stuff simply doesn't matter to making money in the market. What they say on CNBC, they're all well intended over there. They're not trying to harm people, but it's got nothing to do with. I don't have it on. Why would I listen to CNBC during the day? I might as well have the gardening channel on. It's just as useful to me because it's not about trading in my time frame. So know your time frame. That's one of the most important things people can get. Other bigger mistakes are what I see most of the time happening is people chasing things and they're reactive. They wait for that volume. They wait and that volume will come on Friday in Roku as it hits the year-to-date volume weighted average price after a 40% rally. So people start to get excited after the move instead of anticipating where the momentum might come in. And I've shared this chart on Twitter, 100 times. I came up with it, I think I first printed it out in 2008 when I did my book. And it's kind of an expansion of Stan Weinstein's work, of course, and Wyckoff before him. This stuff has been around forever. It's based on the economic cycle. And I'm not going to go through the whole thing. By the way, if anyone wants a copy of this or if you want to get an email once a week to my weekly video, just go to alphatrends.net and there's a sign-up box there and you can get a high-resolution copy of this market poster sent to you. I also put a full-color copy, 11 by 17, in each book that you buy on Amazon. But if you understand market structure, it tells us, how the money flows through the market. And it gives us the objective look at it. What a lot of people do, sometimes is say, we're clearly in a stage 4 decline for the overall market right now. Are we here at this point? Are we here? Are we there? I can only tell you, once we're well past. The point is we're in a stage 4 decline. Some people get a little hung up on, are we in stage 4.2, Brian, or do you think it's stage 4.3? I don't know. We're in a decline. It really doesn't matter. The point is I'm not looking to make a decision about now is time to start buying stocks. If they're in a stage 4 decline, just don't try to buy these stocks over and over again. We've seen these stocks, what was the one on Friday? Upstart, I think, that, again, hit, another gap lower after being down 70, 80, 90%. PayPal over and over and over again. People have been telling me it's a great company, it's down too much and all that. I don't care. It's down. They can they go too far to the upside, they go too far to the downside. If they don't scare you out in this stage 1, they will typically wear you out in stage 1. Stage 4, they don't scare you out. Stage 1. So what is stage 1? So stage 4, we're in, and these are on that poster. I've just kind of put them here so people can look at them. In a stage 4 decline, late decline, we still have downward momentum. We can see rallies and declines come quickly, but violent short squeeze rallies occur. And then as the accumulation occurs, what we see is we start to see those longer term moving averages, they're still in decline. They need to flatten out and give us time to look at the market and say, where do the buyers really gain control? We're going to see rallies, but those rallies are going to fail. Most rallies with a declining 200-day moving average will fail. It doesn't mean there aren't some great rallies in these stage 1 stocks that will fake a lot of people out, that'll go 50%, 60%. But they're still in stage 4 declines, and they're more likely going to dribble back down. So we use moving averages as a simple reference point. I like to use a simple moving average. Richard uses a 21 EMA and a 50 SMA. Use whatever makes sense to you. One thing I'm not here to do today is to tell anyone what they should do. I'm here to open your eyes to a couple of things that work for me. And if it makes sense to you, great. If it doesn't, and you want to argue with me, I'm just going to block you because I don't care. I know what works for me, and I'm not here to convince anyone of anything other than, learn to be objective about the way you look at the market. Have an open mind. But a moving average is simply a reference point, something to compare price to. It's mathematic, it's time-based, it's somewhat subjective because it's time-based, but the market, like history, is an agreed upon collection of lies. The truth in the market is an agreed upon collection of, I don't know, not lies, but reference points. And we've agreed to use a 50-day moving average as a reference point for whatever reason. Nobody sat around and voted on it. It's just become the default. So moving averages don't lead the market. There's no such thing in my mind as a leading indicator. Nothing leads price. Price is the absolute truth. The VWAP doesn't lead price, it follows it. Fibonacci doesn't lead price. MACD doesn't lead price. It can give us, ideas about when the momentum might be waning, but nothing leads price action. If it was, then someone would find it and just use it to make money all the time, but it doesn't exist basically. Is that for me? Okay, no. So, the way that they work, they tend to act as support in an uptrend, and they tend to act as resistance in a downtrend. As I mentioned, it's the psychology of why they tend to act as support or resistance that's more important than just saying, hey, it's a 50-day moving average, I'm going to buy it. That is that's the first grade level understanding of the 50-day moving average. Understanding the graduate school is saying, what are the shorts doing? What are the shorts who are positioned from a higher price doing? Well, they're likely looking at this and saying, hey, it's down to the 50-day moving average. We shorted it as it was 2 deviations higher. Now we're going to start to nibble on some. We're not going to try to be too aggressive about buying here because we don't want to spook the market or tip our hand if there's buyers here. We want to cover as many shares as possible. What about uneducated shorts who are looking at it and saying, hey, it broke below the 50-day moving average. It closed 1 day below it, but the trend of the 50-day moving average is higher. And you get those uneducated people who say, hey, it's below the 50-day moving average. I'm going to short the stock. But they don't look at the trend of the 50-day moving average, and they don't look back to March 28th when with the data that we're replacing in that 50-day moving average right now. And on Tuesday, they don't look at the data from March 29th. And on Wednesday, they don't look at, so I move a bar forward each day to say, here's the data we were getting rid of 50 days ago. What can potentially make that change? If we get rid of this week's worth of data over the next week, that 50-day moving average will flatten out. So it's about anticipation rather than reactive all the time. When prices move back and forth above and below moving averages, it represents indecision. And moving average crossovers are the worst type of indecision. It's telling us, some people think that moving average crossovers are a reason to buy or sell. To me, they're a reason to avoid. It's saying that this, the short-term trend crossed down through the longer-term uptrend. So we've got time frame trend confusion here. That means stay away from it. So when the market is, crossing back and forth above and below these moving averages, it says, just leave it alone. Wait, anticipate. Try to figure out if you have to trade this stock, if it's Apple or if it's Netflix or whatever, try to anticipate, when does the direction of that moving average start to flatten out and turn higher again? What would be the scenarios that cause that to happen? Is there anything in the economic calendar that's going to come as a shock? Is it the jobs number? Is it the CPI number next week? How do I manage risk around those? There's no one-dimensional way of looking at the market. One thing I've been I liked recently is, people have been asking me, they always ask me, so Brian, what's the most important time frame to look at? And my answer is all of them. It's truly about multiple time frame analysis. How does this short-term picture interact with and build upon the intermediate term trend, which interacts and builds on that longer term trend? The sum of the short-term trends is the long-term trend, so the short-term trend leads the long-term trend. But the point is it's how they work together. It's like asking what's the most important ingredient in a chocolate chip cookie. Well, a chocolate chip cookie wouldn't be a chocolate chip cookie if you didn't have chocolate chips. So it must be that. So if you just say, okay, that's all I need is chocolate chips for the best chocolate chip cookie ever. And if you had that, all you would have is a pile of chocolate chips. You still need the dough, whatever makes the dough, the flour, the water, the egg, whatever else, the salt goes into them. They all have to work together. There is no one most important ingredient in any recipe. And it's the same as the true in the market. There's no one most important time frame. There's no one most important moving average. It's a dance. It's how they all flow together to give us the idea of, how they flow together and how we can anticipate. So this is the S&P 500 from 1999 to 2012. So we've got 13 years. And a lot of people on this call probably, weren't trading then. I was trading back, through all of this. And, we've got some simple things on here. I've got a 20, 30, and 40-week moving average. The 40-week moving average is the bold one. That's, the 40-week is 5 days in a week, generally speaking. Sometimes we have 4, due to holidays and that. But generally, there's 40 weeks times 5 is a 200-day moving average. So when we look at a 40-week moving average, we're basically looking at the 200-day moving average. It's not perfect, but it's darn close enough. In 2000, we peaked at 156 in the SPY and dropped over the next 2.5 years to 77, a decline of 50%. Look at these rallies in here. And I've got a chart somewhere I've posted that shows what these rallies are. But these are massive rallies. I mean, this one here is from 100 to 130, a 30% rally. That's a bull market, right? 20% is a bull market. But it's within the context of still right up to that declining 40-week moving average. Rallies with a declining 40-week moving average are generally going to fail. And even here, when we were above the 200-day 40-week moving average, the direction of that 40-week moving average was still lower, and then it failed. So over here, we started to see in mid 03 that the 40-week moving average started to flatten out. So all the people that tried to buy the dip all the way down endlessly got chopped up. If instead if you're an investor, instead you just waited for it to make a higher high above a flat to rising 40-week moving average, you would have avoided all that nonsense and purchased right here at 80, $90, let's call it. And then again, a rising 200-day moving average. It flattened out here, and then we broke support. So, if you bought here at 88, maybe you got out at 138. Up 50 points. It sure as hell is better than being a buy and hold investor and seeing it turn into a loser of 12% 8 years later. So but the point I'm trying to make here is these concepts, whether it's the 40-week moving average, the 200-day, the 50-day, even the 20-day, the 5-day, or whatever, it's the same on every single time frame. If instead you decided, hey, I'm going to sell short when it makes a lower low below the declining 200-day moving average, like shorting right here, and then you would cover over here, shorting right over here, and cover over here, or buy here. And, it got a little choppy in there, but here's where we are today. Does this look like the beginning of a new uptrend? Absolutely not. That thick black line, that's the 40-week moving average. We still have a very clear pattern here, lower highs and lower lows. We've got a declining 10-week, that's the 50-day, 20-week, 30-week, and 40-week. So that's 100-day moving average, 150, and 200. This market is going to take some time to heal. We don't have an accommodative Fed. Maybe that's going to change. Who knows? Who cares? We don't have to know what the Fed's going to do. As the Fed has been clear, they're way behind what the market has done. I did a chart on that on Twitter this week. The market was way ahead of the Fed, and they'll be way ahead of the Fed when the market starts to rally. And the market is a discounting mechanism. It looks forward 6 to 9 months. The Fed doesn't do as good a job as that. They're scared of the here and now. They're scared that if they do something that's preemptive, that they might actually see, because they're not stupid, they might see what the bond market's seeing, but they can't do it for political reasons because, hey, well, why did you raise interest rates? The economy's good, or unemployment's this, inflation's not there yet. It's only 5.2%. Instead, now we're at 8%, and that's when they decide to start to move. So again, the moving average psychology, I think I've covered that. Why it acts as support and resistance is what we really want to know. Richard, what time frame do you think this is right here?
I'd say maybe a 65-minute time frame.
Um, it's got a 50 period moving average,
So
and
yeah, a 15
yeah,
minute time frame.
it could be. The point is, it could be a weekly chart.
Yeah.
It could be a 30-minute chart. No one would know the difference until I do that. This was the S&P 500 on Friday, yesterday. This is a 1-minute chart. Each one of these candles represents 1 minute. Tell me how the analysis on here is any different than any other time frame. That's the beauty of technical analysis. It's the fractal nature. Fractal means basically, the same patterns are going to repeat on different time frames. You only have to understand technical analysis on one time frame and then be able to switch down to shorter term time frames. If we look at the direction of the 50-minute moving average, so the 50 period, the period that we're looking at is 1 minute on each one of these candles. If we bought when it made a higher high above the flat to rising 50 period moving average, we bought at 387.25. If we got stopped out as it made a lower low, maybe we got stopped out right here at 389.25. So that's a nice 2-point rally. What if we shorted when it made a lower low below the flat to declining 50 period moving average? We would have shorted it at 389 and then cover right here as it makes a higher high at 388.75. And then what if we buy again as it makes a higher high above the flat to rising 50 period moving average at 388, and then we get stopped out at 389 and a quarter? It doesn't matter what time frame you're looking at. The concepts are exactly the same. The cyclical flow, I'm not making this up. I didn't go cherry pick. I've been using the S&P 500. I said, let me look at the S&P 500 on a 1-minute chart. I'm going to put that on there. Whatever it is what we get. And this, we just can't make this up. There is order to the market. What about the bonds? Should we care about the bond and what the Fed is saying, or is it just better to look at this chart instead? This is the TLT, the 10-year notes. Back in 2019, they started to rally. They made a higher high above the flat to rising 40-week moving average. They continued to find buyers on that pullback there in late 2019. Then it broke below it and made a lower low. So right there, you want to enter, exit your long. So if you're an investor, you bought here at 125 to exit at 160, and then avoid all this nonsense that came. As it started out, maybe you purchased right here. That's a higher high above the flat to rising 40-week moving average. Does anything work all the time? No, of course not. That's why we have our stop. When it comes to stops, the way I look at it is, one, I'll look at the weekly and say, here's where I'm entering. Here's the thesis for my trade, but I'll look to shorter term time frames. And my stop, if I was in here, probably would have been under this candle right here, this big white candle, the breakout candle. And as it failed, as it broke below that, it said that failed. I don't want to be long anymore. The pattern of higher highs and higher lows that looked like it was emerging doesn't exist. So why would I want to be long? So I take my small loss and move on. And I say, hey, it's making a lower low now, but below the flat to declining. So now I'll short these bonds and stay short until such time that the market tells me. Or maybe you start managing it on shorter term time frames. There's no perfect way to trade any of these things. The only perfect way is what people know after the fact. We have potential levels of support and resistance. We have areas of interest. So what I want to talk about a little bit is the 5-day moving average. If you follow me on Twitter, you saw this week, I talk about this all the time and use the S&P as an example mainly, but it's what I do with stocks on an individual basis as well. I just, the S&P is consistent, so I talk about it every day. And I think that's there's a little bit, I'm not really an S&P trader. Sometimes I trade the SPY and maybe some of the leverage stuff, but I look at it as a consistent way of showing analysis, that it's there to see each and every day so we can see the concepts. The concepts of what I was pointing out earlier in the week, we're starting to turn sideways, but the 5-day moving average is flat. And then on Wednesday, we're turning, the 5-day moving average is starting to flatten out. And if we get rid of this data from last Thursday tomorrow, and the stock is in this area, it'll be above the 5-day moving average will start to turn higher. So I'm anticipating what makes it so that the market could potentially turn. So we have to identify what a market day is. A market, the market is open from 9:30 a.m. to 4 p.m. Eastern. Of course, I'm talking about U.S. equities. That's what I trade. That's all I trade. I don't trade any ADRs, any foreign markets, Forex. I do a little bit of Bitcoin trading, but that's a different beast, and I'm really kind of off that for a while now anyways. But the market's open 6.5 hours a day, and that's important because if we look at charts, we want to look at consistent. We want to look at apples. We don't want to look at 6 apples and 1 orange, meaning if I look at an hourly time frame, I don't want to look at, that first at 9:30 to 10 is considered one full candle on an hourly time frame, but it's only 30 minutes of data. So any moving average I have put on there, any VWAP, anything says that first half hour is twice as important as each of the following candles. So what we need to do is say, let's break this down so we can make more sense of it. 6.5 hours is 390 minutes per day. So if I'm looking at 5 days, I want to know the average of the last 5 days. I want to know the average of the last 1,950 minutes. The 390 times 5 is 1,950. So if I'm looking at intraday time frames, I don't want to look at any time frame other than these. So if I look at 195 period, that means there's 2 equal candles per day. 130 minute, there's 3 equal candles per day. 130 times 3 is 390. A 78 minute sounds goofy, but if you do 78 times 5, it equals 1,950 minutes, etc. Over and over again. So we want them equally divided. So I don't want to look at a 4-minute time frame. I don't want to look at an 8-minute time frame. I don't want to look at a 60-minute time frame. I want to look at a 65-minute because there's 13 of those over 5 days. Or if I look at a 30-minute, there are 30-minute, there's 13 times 5, 65 of those. So the way to look at a 5-day moving average, and I'll show you this on the chart as well, we want to look at the average of the last 1,950 minutes. If we look at a 5-day, if we're looking at a daily chart, we start with daily candles, and we're looking at it at 10 o'clock in the morning. What do we see? Well, we see a 5-day moving average is actually the last 4 days plus 30 minutes of today. It's not 5 days until the end of the day. So I want to look at time frames where I can say, here's where the true 5 rolling days are. Any point in there captures 5 full days. So on a 10-minute time for on a 195-minute time frame where I have 2 equal candles per day, over 5 days, there's going to be 10 of those because there's 2 candles per day. 5 days, it's 10. So over to a 10-minute time frame, 195 period moving average is the 5-day moving average because 195 times 10 is 1,950. 15 times 130, 26 times 75. They all equal 1,950. That's how you do the conversion. This is the S&P 500 through mid-morning yesterday on the SPY. And these are ones, these are trades and things that I was pointing out on Twitter that, we're in a downtrend, but, if you're looking for bounces, you anticipate as the 5-day moving average starts to flatten out, you anticipate that it's going to make a higher high above that flat to rising 5-day moving average. And then you participate as it enters there. And you set your stop. So the next day it gaps up, the stop will go under here. As it makes a higher high, raise your stop under here, boom, you're out. So basically a break-even trade. It pulls back and you avoid this big decline from 406 down to 382. It then creates this little inverted head and shoulders pattern. But what is an inverted head and shoulders pattern? It's simply just a transition of sellers in control with lower highs and lower lows to buyers in control. Now we have a higher low, and if we break this, we have a higher high. So at that point, as it starts to flatten out, we participate right here. I remember this was Federal Reserve minutes that day. and it had a beautiful rally from 397 to to 416. And if you start to put numbers on these, what would you see? This would be a stage one accumulation right in here, stage two uptrend, stage three distribution, stage four decline, stage one accumulation, stage two uptrend, stage three distribution, stage four decline, over and over again. So when we're looking at these, we either want to short, if we're long, worst case was an exit over here. Realistically, an exit underneath this higher low. But this would be a place to sell short and ride this trend down and maybe get stopped out on this candle right here. Didn't get you out at the bottom, but that's not the goal. Only liars get in at the out at the bottom of their shorts and in to their longs. So right now we're on a buy because the 5-day moving average is higher. That we have to realize, though, that's within the context of a much bigger downtrend. What's your time frame? This is a swing trade. I'm giving the bias to the long side right now, but it's with less confidence. So here's a 5-day moving average on the daily time frame. Again, there's that math. Here's how it looks, and I'll just go forward so we have them all four together here. So this is the same. I put this together a while ago. There's no reason to change it. But what it does is allows us to say, here's where, when we look at a 65-minute time frame, a 30-minute time frame, or 15, that 5-day moving average is going to be in the same spot on all these time frames, and it's going to show the same slope to it. So it becomes a true reference point as we move across time frames. One mistake that people do a lot is they say, Brian, I put a 5 on my 65-minute time frame, and it doesn't look anything like yours. It's because they put a 5 period on. They didn't adjust it to a 30 period moving average. So I always have to put this in here because we're still in a decline. Don't buy the dip. Buy strength after the dip. NVIDIA. Everyone loves this stock. Everyone's been trying to, well, not everyone, but a lot of people are still trying to buy the dip in this stock. But, here's 26 through 2020. It was a monster stock. And then it dropped 57%. And people were trying to buy all the way down, just like they're doing right now. It's down too much. It's a good company. Their earnings are going to be this. They're selling Bitcoin miners. There's this new gaming system coming up, and they're going to have this chipset for Web 4.865 and all the bullshit we hear. The point is, it's in the downtrend. It's below these longer-term moving averages. We're going to see big rallies. This was a huge rally from 30 to 48. But guess what? It was still had a declining 40-week moving average. So it was destined to fail. It took 9 months. If they didn't scare you out, it took 9 months of sideways action for that 40-week moving average to flatten out right in here. And then as it makes that higher high, why not just make life more sane and buy on the way up? Let let the institutions battle it out and create all this nonsense here, and then ride that wave as it starts to break. You ride it all the way in till it starts to say no more. This is NVIDIA today. What if we had a similar type of action? So, from that 2019 buy right here, okay, if you bought right there, it rallied 686%. And now we're below all these key moving averages. This is where we were midday yesterday. And I just drew this in and said, hey, what if we rally up to this, the 40-week moving average? This is about the slope that it's taking. What if we rally from 140 to 190? A lot of people say, hey, that's it. I'm the genius. I picked the low. But what's more likely is, it bounced from the 14th floor. It bounces up to the 8th floor. It comes back down, bounces to the 4th floor. But why not buy it in 6 to 9 months after we've we've wrung the towel out and we know who's in control. The buyers are back in control. Now you can buy it in your investment account. Now you can buy it in your 401k. Some people hide and say, hey, well, it's in my IRA. I'm in it for the long term. That's your IRA. That's your retirement. Are you fucking kidding me? That's your most important account. You can't let things just slide in there. You have to manage that money more aggressively than any other money. That's how you're going to retire. And you don't have to worry about taxes in those accounts. Occidental Petroleum, you don't have to worry about tax consequences of buying and selling that. Anyways, let's talk about a stock that has been a recent winner. Occidental Petroleum. It was a Complete piece of garbage through 2018, 2019, 2020. You didn't have to buy the dip. You didn't have to buy that big gap down. Oh, it's a value. Good, great. If you're truly in it for the long term, you bought it at 14, but you were down, 30% a year later. Psychologically, you felt like a loser. I know you did. I would have felt like a loser. You felt like, well, what's wrong with my process? What's wrong with this company? Why not wait for that 40-week moving average to flatten out and say the buyers, the institutions are in control now. We've wrung the supply out. Let's buy it a little. Let's buy it twice as high. Let's not buy it at 10. Let's buy it at 20. And now we've got the wind at our back, and we're still in this giant uptrend. So, where does that leave Netflix? Here's just another example with Netflix. Netflix dropped 81% in 2011 and 2012. It took over a year for it to flatten out and show a higher high above the flat to rising 40-week moving average. And when it did, it went on to have a huge rally. Here's where we are today. What's the hurry? We're down from 720 and we're at 187. What is that percentage? 75%? If this 40-week moving average is going to flatten out, it's going to take some time. Forget about Netflix. It's yesterday's news. So just some general rules about moving averages. We're going to take a look at a bunch of stocks. Trade in the direction of the primary trend, whatever the moving average is for the time frame that you're involved. Forget about what other people are doing. People are saying, well, I see this. When people on Twitter say, well, Brian, the longer term is it? I don't care. Let's, leave me alone. I'm doing my trade on my time frame. Have blinders on. Mute people, block people. It's all noise. You don't owe anyone anything on Twitter. You have to protect your personal mindset above anything else because there's so much noise out there. But you want to look at it and say, where are we? We're on stage 1 or stage 3. Well, it's crossing back and forth above, below the moving average. Is it stage 1 or stage 3? I don't know. If it breaks higher, then it's stage 1. If it's stage 3, then we'll know because it breaks down to a stage 4 low. But if it's just moving back and forth above and below them, who cares? Just leave it alone. Anyways, they're a great reference point. The two most important questions you can ask before you get involved in a stock is, one, where has it come from? Has it expended a lot of energy? I heard Patrick talking about that a little bit about, buying stocks that are extended. Learn to anticipate. Don't wait for the breakout when it just rallied 10% in the last week. I bought that stock 10% ago, and I'm absolutely guaranteed going to sell some to you on the breakout. And there's institutions doing it as well. There's a reason people complain, hey, breakouts don't work anymore. Well, of course they don't work because people bought in advance of the breakout. And when the uneducated later money gets to it, they're going to say, hey, now the uneducated obvious crowd is getting involved. I'll sell them a piece of mine. So then, that's where it's come from. What's reasonable? The stock was up 10% in the last week, and we're in an overall downtrend. Is it reasonable to think it's going to go another 10%? Not really. I mean, it's anything's possible in the market. We have to think about what's reasonable. Is it reasonable that it's going to go another 10%? If so, have a really tight stop. But where does it have the potential to go? What's the potential reward? So here's my stuff. You guys probably already follow me on Twitter. My book is on Amazon, etc. So again, if you're interested in my weekly free email, it just has my YouTube video, and I'll be making updates about my new book in there as well as I get more information about the publishing date and that. So just go to alphatrends.net and we can talk, and I'll give updates there. So I guess I can talk about some stocks and some of the names that I'm looking at. So for instance, I'm in CELH, and Richard wanted to talk, I know, about getting involved. Patrick was talking about scaling into stocks and buying 30%, initially 40% initially, adding 30%, and then adding that last 20% as you have confirmation. I tend to do things opposite that. My time frame again is different. My screen is frozen. This would probably just take a minute to unfreeze. I don't know what's going on with that. But the way I like, what I think my advantage in the market is that I'm very good at the timing. So when I see a stock like CELH, I've been looking at this one like a lot of people have. It finally got back above the volume weighted average price from that peak right there. It was having trouble with this declining 200-day moving average. It rallied up again, found buyers at the rising 20-day moving average in there. So it was on my list as a buy. I bought it Tuesday morning of this week right in here. And the very first thing I go in full size. I feel like my advantage is I'm either right or I'm wrong. And if I'm wrong, my stop is under here. Right? Actually, initially it was under here. So I'm going to have a tight stop. Why is my stop under there? Because that's the most recent relevant higher low prior to this higher high that it's making. So if it comes down and breaks the higher low, my definition of emerging trend no longer exists. I don't want to own it. So I buy a full-size position. And then when it rallies quickly, I sold some at daily R2 that day. That gave me a $3 gain on the first third. And you can look at it and say, wow, Brian, you gave your stock away. And you could argue that's true. Or you could say, but that's part of my process. If the stock had failed, and we have hindsight to say, oh, yeah, that was dumb of me to sell there. We don't know what's going to happen. I truly believe when I say risk management is job number one, it's not just a cute little phrase. It's what I believe, and it's how I implement it every single one of my trades. If I was wrong here, it's not going to be a big loser because I'm going to get out right here before it does something like this. I'm not going to, start reading 10Ks, 10Qs, insider transactions and go down to CVS, make sure it's still fully stocked or whatever. I'm interested in the supply and demand of the stock. And as it rallies quickly and it breaks this high and hits daily R2, I'm going to sell my first third because I've gone in with a full position. And oftentimes a full position means I'm a little uncomfortable with my full position. I want to pay for my risk as quickly as possible. So if I can take $3 per share off, and that lowers my cost basis by $1 on the overall position, right? If I take the $3 off on 1/3. And then as the stock rallies, then I raise my stop to break even. Now I can't lose in this trade. Even if it goes, negative, I'm not going to allow it to turn into a loser. And instead it rallied. I got stopped out of a third right here for a gain of $8.10. And my current stop on the balance is right here. Maybe, what I think is most likely to occur with CELH, and I already drew it in there, is something like this. This is what I think is most likely going to occur. So why don't I just sell that final third right here, right now, if I think that's going to happen? Because the market doesn't care what I think. It might end up just doing this. I want to hold that last third because if I can get 5 more points out of it, that's fantastic. But if it does what I think it will do, something along the lines of this, and then it might even take a couple days for that 5-day moving average to, undergo a little bit deeper profit taking. And then again, it's always about anticipation. It's not about what, it's like what Wayne Gretzky used to say. It's not where the puck is, it's where the puck is going. So here's the 5-day moving average. I start to get interested in it right in here because that 5-day moving average is flattening out. And then I see a higher low. We love to see that higher low because now I don't have to put my stop under here. I can put my stop under here or under here. And this is where we have a stage 2 on the short term. So here's a stage 2. This could be stage 3, stage 4, stage 1. This is the beginning of stage 2. And guess what the volume is going to look like there? It'll be real low. And then the volume is going to go like this and increase as the confidence does. It's lonely buying there a lot of times because the volume isn't there yet. So this is what I think is most likely going to happen. But I've learned the market doesn't care what I think. So I'm just going to hold my stop down here at 73.96. Is that my 74.96 rather? And if I get stopped out, that's great. It's up from my cost of 66.15. It's a great trade. I don't need to get out at the high. I've got 1/3. Bulls and bears make money, they say, and pigs get slaughtered. Greedy pigs get slaughtered, but disciplined pigs get rich. Be a disciplined pig. And that's what I'm trying to do, is be as piggy as possible And, I'm anticipating all potential scenarios. But if this happens, well, that's going to take a week or so. And then maybe on, the 15th or the 18th of this month, it's a buy again. But I'll avoid this pullback. There's no reason to be involved in it once it's going back. I don't need to go look at the, earnings reports and channel checks and that sort of thing. That's not my time frame. That's not my goal. That's not who I am in the market. Let's talk about, I got involved in Amgen on Friday. It's kind of, it's Amgen, it's not really a great trading stock. You can see how choppy it is. So you always be aware of the personality of the stock. Look how choppy it is. But, biotechs are strong. This one is coming out of a pretty tight consolidation. It's easy to manage risk here. That was the initial stop. Now my stop is under here. I've raised my stop from 146, 144. I'm sorry. My original stop was 244.20. Now my stop is 246.20. That's the most recent relevant high or low. So I've already cut my risk by 2 points, and the stock hasn't done it. I haven't taken a third off, but I've already reduced my risk because the definition of trend, higher highs and higher lows, we had the higher high, and now this is the most recent relevant higher low for my time. AMN is one I'm looking at for Monday. Here's a daily chart. You can see that it broke this resistance. It had a pretty big rally, which sometimes, where has it come from? It came from 85 to 110. But it blasted through what should have been, what most people would have looked to be resistance. Instead, it leapfrogged right above it, and now it's holding beautifully above that level and consolidating with now again a rising 5-day moving average. So I'm looking to buy this one above here, and my stop is actually going to go right here. I'm not going to wait for this stop. This is my level. And if it comes down and breaks that first, the risk reward has changed. So I'll have to reevaluate it. But that's the way I look at some of these. Boyd Gaming is one that, still looks like it's destined to hit the COVID anchored volume weighted average price. It's below a declining 20, 30, 20, 50, 100, 200-day moving average. You look at the weekly time frame. That looks like a big stage 3 distribution, a beautiful stage 2 uptrend. Bigger the top, the bigger the drop. It looks like it's got an appointment down here with this COVID volume weighted average price and 200-week exponential moving average. That becomes a potential level of where it will go. So now we have to look at it and say the 20-day moving average has been holding it back. This prior support was tested. It held as resistance. That's one piece of evidence. The 20-day moving average held there as well. And then it held again this week as it rallied. What was the volume on the rally? Relative, the volume on the rally, it was expanding, but relative to the average daily volume of 1.3 million shares, it was well below it. Let's look at a 30-minute time frame. Where are we? And now we start to add some anchored volume weighted average price levels. This was an important level, that gap. The average person from that gap is now losing money. From this low, they're losing money. From that high, they're losing money. From this gap lower. It's telling us from all of these points, the average long participant is really positioned somewhere around this area up to here. So what does that tell me? What do I do with that information? It tells me that, one, if it gets back above there, I certainly don't want to be short anymore. So what does that tell me? It tells me to stop. If it gets above 50 and a half or whatever Friday's high was, I don't want to be short this thing anymore because maybe it's going to squeeze and then it's going to drop later. Shorts are difficult like that. So let's drill down to a 15-minute time frame. Here's, again, if it breaks below here, this is what I'm looking for. If it breaks below here, then I want to short it with a stop, worst case above Friday's high. So those are the ways that I anticipate and, look to get involved. ABBV. This one is probably a couple days early. You can see that 50-day moving average is still declining. Where were we 50 days ago? We were right here. So that means on Tuesday and Wednesday, when we replace, we get rid of this data Tuesday morning, that 50-day moving average, if the stock is right here, that 50-day moving average is going to start to look like this because we're getting rid of this data and replacing it with this data. The stock can just go sideways on Wednesday, and the 50-day moving average will begin to rise. A lot of institutions look at what's the direction of the 50-day moving average. So I'll stop talking here. I just wanted to kind of tie some of those things together a little bit and open it up just for questions about any stocks at all, VWAP, whatever anyone wants to talk about, or you, Richard.
Yeah, fantastic. And as I'll be asking a few questions first of all, but then if you have any questions, anybody watching, leave them down below in the chat and we'll get those answered as well. To start things off, Brian, I'd love to hear you talk about how you set your position sizing and whether that's based on, how far above are we from that relevant higher low where you place your stop loss.
I like to do it on, based on the R multiple concept. So, just let's say your risk is $1,000 per trade on your A setups. That is your best setups. I'm going to risk $1,000. The way I like to look at it is I want as many shares as possible in that stock. So if I am, for instance, looking to get long AMN, I want to look at it on this 15-minute time frame. What I really want to see happen is I want to see it do this. I want to see it come up to that level. I'd rather it takes a day, day and a half to do so, and it tightens up really nice and then breaks higher. Because if it does that, it tells me that instead of having my stop down here, and let's just call that 2 points. I'm just for reference point.
Yeah.
And if I'm risking $1,000, if my stop is 2 points away, that means I can only do 500 shares. But if it tightens up like this and my stop is 50 cents away, that means I can do 2,000 shares. So I can do 4 times as many shares and still have the same amount of risk in terms of dollars. But now my profit margin is so much, my profit potential is so much bigger in this trade. So I always really love to see, I love to see a stock that kind of rallies up, has a little shakeout maybe, traps people, then creates the higher low. And then that tells me that they got the weak holders out over here. They probably suck some short sellers in. Those guys are going to look to cover. The weak longs are going to look to get back involved. And guess what? The longs who held through that are saying, no, you're not going to get it that easily from me. You can come buy it this afternoon at 117 from me. That's why we see from failed moves often from fast moves. So it's all about the tightness of the stop. And I'd love to find as tight a stop as possible. And sometimes the stops are a little bit too tight. So I might end up actually staggering my stop where I think, that's just a little bit too tight. I've got to give it a little bit more wiggle room than that 36 cents. So maybe I'll put half my stop here and half my stop there. And instead of doing 2,000 shares, I can do 1,500 shares.
Perfect. And what are kind of your routines for finding ideas and also overall general market analysis? You put out a great video every single weekend discussing that. But what do you kind of do every single day and every single weekend to prepare for the next week and find good ideas that match your trading style?
Yeah, my weekend process is watch list. I have these personal watch lists, and I have this master watch list, which right now has 1,000 stocks on it. I'm not interested in those 1,000 stocks, but I might look at it, somewhere, a screen that looks something like this. So let me go back and find that watch list. And I'll just go through alphabetically, and I simply do this. And I look at not just these 4 times. So the time frames that I have on my large screen, I have a weekly time frame, a daily, a 65-minute, a 30-minute, 15-minute, and a 5-minute time frame. And I'm looking at them all simultaneously. So I can see, where are we in relation to the COVID VWAP, last year's volume weighted average price, this year's. On the daily, I've got the 20-day and the 50-day moving average. I've got the 5-day moving average over here. And just looking through these and just going down and, coming up and creating little lists like this, putting little checks next to them, putting it onto my notebook that these become the trades. And when I go through all these stocks, it might sound tedious, but it's work that I enjoy. I can get through that list of 1,000 in 2.5 hours. Less if I'm really focused, but I have a problem with focus, so it's usually about 4 hours. anyways, what I see when I look at that and I get my list, I start to see, hey, well, look at that. And 3 weeks ago, I might have been looking at it going, there's another biotech stock. There's another biotech stock. Look at that. The banks look weak. Why is it? And I'm not going to trade all these names. It's never my intent. And that's not my universe of stocks I'm going to trade. Most of those stocks I've never, ever traded. But they give me an overall look at the market. So I'm listening to the market. There's nothing wrong with scans. Scans can be a great tool. But for me, my advantage is that I've been doing it long enough. I can get through this large universe of stocks. And at the end of it, I start to find takeaways.
Mhm.
There's more stocks that are starting to, they're in that late stage 4, early stage 1. We're seeing these garbage names, starting to bounce and people are getting excited about them. But there's still, where are we really in a stock like Roku? Are we in an uptrend here? Or Roblox, are we in an uptrend? Does this look like a stage 4 uptrend when we look at the weekly time frame? Or is it a stock that's in a downtrend that's most likely going to do something like this? And maybe it rallies, up to the 40-week moving average, but more likely to do this. And then in a, 6, 9 months, then it can sustain a larger advance. But for now, accept it for what it is. So it allows me to see what's working so I can anticipate what is most likely for the market rather than going to the market and say, okay, here's my shopping list. I like stocks that pull back to a 20-day moving average on half the volume they traded of the prior 3 days. Nothing wrong with those. You can find some great names in those. I created a scanner once, but I shut the scanner down. I had a full, 3 time frame scanner. It's called the Alpha Scanner. And it was a great product. But I never used it so I couldn't, it failed as a business because I couldn't promote it because I wasn't using it. Because I could go in there and say, show me the stage 1 accumulation on a weekly time frame, stage 1, 1, 1, 2, and 1, 3, and 2, 1, and show me on a daily 1, 3, 2, 1, and then on a shorter term time frame, I could say, show me the stage 4, 3, 1, 1, 1, 2. So I've got these longer term bases that are just starting to break out, but they've pulled back on the short term time frame. And that's kind of what I'm doing in my mind when I go look at these, multiple time frames is I'm saying, how do they all come together? This is still a broken piece of garbage, RCII. These are, it's going to take time for Redfin to heal on this weekly time frame.
Yeah, perfect. And I also wanted to hear a little bit more, if you go into a little bit more detail about your position management once you actually already have, a position established. What do you do? When do you kind of take profits? I know you like to take it off in thirds. So when do you take those profits, as well as how do you manage your stop loss and move it up to the next relevant higher low?
Right. So again, with CELH, I can use this example. Buy it as it starts to show that strength. On day 1, if I have strong momentum, I use daily R2, which is the floor trader pivot. So here's what I keep it on 1 time frame here, and that's and I didn't get a chance. I didn't sell some in Amgen. I would have here at daily R2 on Friday. It didn't get there. But that's my first third off. And my first third off is to help me reduce my position size so I have less risk. It's not about making $1.40 on a $250 stock. It's about taking some of my risk off, paying for some of my risk, and putting myself in a position of strength as best I can from that real, the most uncertainty we have in a trade is when we first enter it because we don't know what's going to happen. So if I can remove some of that uncertainty by taking a little bit of risk off, then that's what I want to do. Going back to CELH, what I then do is raise my stop underneath the most recent relevant higher lows.
Mm-hmm.
So in here, and these were actual levels, and it was under here that I had gotten stopped out of a third. So you can see where that was violated. At that point, I was stopped out for a gain of $8.10. So I took a third off first day at $69.10. Another gain here, and my final third we showed a low of 75 on Thursday and Friday. My stop is 4 pennies below that at $74.96. So what I'm trying to do, Richard, is to use the definition of trend. I had my stop under, on this day, I had my stop under here. As at the end of that day, I said I'm going to raise it a little bit underneath this level. It held on Friday, so I'm keeping it there. And if I get stopped out, that's that. That's the definition of trend that I'm most interested in. So for now, on this 10-minute time frame, for instance, you could look at it and say, we have the potential that this high now has a lower high, and if this low is broken, well, then is my definition of trend still existing on my final third? No, it's not. So I want to step to the sidelines, and then again, if that were to happen, I'm not done with the stock. I hope it does this, and that 5-day moving average comes around like this again, and I'm buying here with a stop under there, third off, and then if it starts to do this, I'll raise it, at this point, I'll raise it under here. As it breaks a new high, I'll raise it under there. As it breaks here, and then I might get stopped out underneath that low right there. So it's definition of trend.
Perfect. And
Long or short.
yeah, that's perfect. And coming back to kind of your process finding ideas, are there any kind of mandatory criteria for you? Like, for instance, previously you said you never, fight the trend of the 5-day moving average. And I was also wondering if there's kind of any liquidity, average number of shares traded that you look for as well when you're looking for ideas.
Yeah, my personal is a 20-day average of at least 500,000 shares.
Mm-hmm.
A lot of places will use, I think the Market Smith, their average daily volume is 50 days. What I find on the 50-day one is, I'll find a lot of stocks that meet the 500,000 shares on a 20-day average, but they might have just started getting going recently. And we traded, 1,000,000 shares, 1,000,008, and then 800, 700 as it pulls back. But because the denominator of 50 is so large, it's not responding and hasn't shown
Right.
that it's 500,000 yet. It's still at 386,000. So I use a 20-day moving average, which I've just, created on TC2000 here. And you can see I've got that up here on every one of my charts.
Mm-hmm.
So the 20-day average of CELH is 1.1. On SWR, it's 793,000. BAH, 1.1. So that's my personal criteria.
Perfect. And there's a really good question from Simon that I'll bring up on the screen here. Have you shortened the swing time due to increased volatility? So do you adapt kind of your style and how long you hold stocks based on the volatility of the market?
Yeah, I mean, I'm much more, I'm less tolerant of wider stops. And I've been a lot quicker that if the stock doesn't make it all the way to daily R2, I might take some off that day because I don't want to hold the full position because we've got these headlines that, can gap the market each and every day. So I will reduce exposure at the end of the day for subjective reasons. If I feel I'm too heavy based on the market and, if we've rallied 3 days, it wouldn't surprise me to see a gap down type of thing. So I just always want to, I play a super strong defense. I'm extremely risk averse. That's counterintuitive to most people who hear what I did. When people say, oh, I'm a short-term trader. Wow, you must like risk. No, I can hate risk. I do everything I can in my power to control it. That's why I'm a swing trader. That's why I'm a short-term trader, because I can't withstand these 20, 40%, drawdowns. Like your Zoom you're telling me about that's down 80%. You're the risk taker, not me. I'm controlling risk. That's why I gravitate towards this time frame, because I'm risk averse.
Perfect. And there were a few questions earlier about where you place your anchored VWAPs. I know that's a subject you've talked about a lot, and you're writing a book, which I'm sure will be excellent on that subject, but maybe a quick review, that'd be awesome.
Sure. I mean, the basic things, you can see I've got a couple on here that if you look at the daily charts that I post on Twitter that I have, actually, it's this screen right here. So here's 3 different time frames, and this will just give you a little bit of an idea. So on the upper, I have a weekly chart of the SPY, then I have a monthly chart of the Q, and this is supposed to be IWM, and a monthly chart of the Russell 2000. Now, I have the weekly chart of the SPY because this is the longer term one that I'm interested in. And actually, I need to, for some reason, get deleted off. I'm supposed to have a green one right here from the 2018 low, because that's the next one of interest on the downside for me. So I'm aware again of where are we in the overall bigger picture. So on the weekly time frame, we're right at the volume weighted average price from COVID. That was prior support. Now it's battling it as potential resistance again. On the Qs, we're at the 2018 volume weighted average price and the 2016 volume weighted average price from the Russell. So I'm aware of the big longer term levels. That blue line up there is the 2021 VWAP from the beginning of the year. That's been important, and still it's unusual to leave it on this long, this far into the year, but it still has been relevant. The pink one is the year-to-date volume weighted average price, and then you can, once you start looking at that data, you drop down to the daily time frame below it. And you can see here I have them labeled. So on the Qs, that pink one that's on the SPY, the Q, and the Russell, that's the year-to-date volume weighted average price. The blue one, that low in February was an important low. So, and it had been resistance in all these markets. So I've kept that one on. The March 29th high has been important. And it's pretty interesting when you look at that March 29th volume weighted average price. I can show you a handful of stocks, including ARC, that are right at that right now. So important highs and lows. So the low from June right here, the June June high VWAP, the most recent low, that's in orange. And then we go down to the shorter term time frame here. This blue is the week to date volume weighted average price, and the pink is from that prior low. So that kind of answers it. But the real answer is, from important swing highs and lows, from anything that changes perception. So I remember that this gap right here was the Federal Reserve. And you can see that when they made their comments, that had been important, and it was kind of a fulcrum point here for even this move higher. So, I like to go back and look at different ones on different time frames. So I'm not, so here on this daily, there's that 2018 volume weighted average price on the Russell. There's the COVID volume weighted average price, and you can see how it had been support, then a battleground, and then resistance.
Mm-hmm.
Going to, again, like ARC, here's that volume weighted average price from the March 29th high. So, from key swing highs and swing lows, from gaps, from earnings reports. Some people will say, they do it from the biggest volume bar. And, to me, unless there was a big movement on that bar, it's not really as relevant. I like to say from a certain move. So if I'm looking at ARC, I might look at a 65-minute time frame and say, what about from that gap right there? Well, that was pretty much close to that 29th VWAP as well. So from highs, lows, important swings, different inflection points, that sort of thing.
Perfect. And you've definitely touched on a few of these, but in terms of kind of what you see on Twitter and people who you teach, what are some common mistakes that you see many kind of beginning traders out there making, and what can they do to rectify those?
Number one, chasing stocks. It blows my mind how often people ask me about Roblox, on Friday. They weren't asking me about Roblox down in here. In here, I would have said, listen, it's neutral at best, is what I would have told you. And I'd say, hey, now we're getting a bounce and a downtrend. Be aware the volume weighted average price from January 1st has been sold several times. I wouldn't be surprised to see sellers there again. But again, where has it come from? When you look at Roblox, we had this rally from 24 to 44. It nearly doubled in an overall downtrend. It's time to take profits and move on. This stock, it would be highly unusual for it to continue to rally higher. What's more likely is maybe it traps some people up in there and then kind of does this and maybe makes a new low and then just kind of bleeds out and everyone stops talking about it again for a while, similar to Zoom, until some crazy lady comes in and says it's going 10 times higher. in the next 2 years, um, things like that. So it's, I think I lost my train of thought, but I think that answered the question as well.
Yeah, basically common mistakes that you see a lot of
Oh,
traders making.
yeah.
Yeah.
Again, so to answer those are, where has it come from? If it's been up a lot recently, and where does it have the potential to go? Where there might be resistance. In other words, where is there the potential for supply to be strong enough to become resistance? That's a level of interest. If you look at it and say, hey, it looks like clear sailing for a while, then maybe there's still an opportunity to get involved in that stock with a strong momentum. Maybe you can still buy Roblox if you buy it above this high right here with a stop under there. What's your time frame? We're thinking of, and here you can see it's pinching between the 1 and 2 day volume weighted average price. That wasn't a setup. I had no idea. It found buyers. So maybe you were looking at this on Friday and said, hey, it's at the 2 day volume weighted average price. I'm going to buy as it breaks above here with an eye towards today's volume weighted average price as a day trade.
Mm-hmm.
Again, these times, it doesn't matter. This could be a chart with monthly candles, or in this case, it's 2 minute candles. It makes no difference. And that's something that people really need to understand and understand market structure. What is a bounce in a primary downtrend versus, what's a stock in an uptrend that can sustain an uptrend? When you look at a stock like ALKS, which I don't know what that was, look at the weekly chart. That is looking like it has the potential to sustain a move, maybe up to here, maybe up to these levels. Do you like cups and handles? As it's above all the key moving averages, it's above all the key volume weighted average price levels. Here's a stock where buyers are in control. Buy stocks in uptrends. That's smart points, though. Don't just chase them after they've made a move. Don't be the guy who buys, on, let's say it breaks out next Wednesday. Don't buy that breakout. That's just stupid. It came from 26 and a half to 23. Let it break out, pull back, shake the uneducated people out, and then as it rallies back up, buy it right here with a stop under there. So where does it come from? Where does it have the potential to go? Don't chase. Understand market structure. Know your time frame. Tune out the noise. Once you're in a position and you're losing money and you start looking at headlines, you should hit the sell button instead of looking for headlines to justify your position. That's something, I've made every one of these mistakes myself. I didn't get here 30, years later by doing everything correct.
Perfect. And there was a question previously about, do you use mental stops and watch how the volume is when the stock's, coming to the level where your stop is, or do you put in hard stops with your broker?
Only price paid. Volume's got nothing to do with it. I don't wait for volume. If you're waiting for volume, you're going to be reactive again. You want to be the first one there. When it hits that price, I've likened it to, the lifeboats on the Titanic. Women and children aside, me first, I'm jumping in. I wouldn't do this, by the way, but I'm just saying you have to be that mindset in the market. It's about me. I want to get out before this ship goes down. I want to be safe with a blanket on the sidelines going, wow, I'm glad I didn't wait for volume because only price pays. I don't care what the volume is. Volume follows the trend. Look at the volume on any stock. Volume expands in the direction of the trend and diminishes with the consolidation. That's just the way it always is. It doesn't matter. It's not so important for the markets. Theirs just always go up on lighter volume. That's just the way it is. The volume diminishes, but on the heavier volume does occur on these downtrends. But all the rallies in the markets over the years, the volume generally looks like this: diminishing volume with a few spikes here and there. It's more important on individual stocks. Buying PRVA, where as it breaks to a stage 2 uptrend after it got above the volume weighted average price from the IPO. This is when I bought on Tuesday and put it on Twitter right here. And that was, a perfect one right there. And I sold something of this. I didn't even look I know must have been news. I didn't look to see what the news was, but who cares what the news is? I'm not in it to read news. I'm here to make money.
Right. And I figured you'd be an excellent person to ask this question. What is your favorite trading quote and why?
Oh, you guys know me. I've got a million of them. I'll put that little sheet together. I'll tweet that out after.
Yeah, perfect.
I guess only price pays because one, I think I invented it, and even if I didn't, it doesn't matter. But it really just kind of ties together everything that Forget about what the Federal Reserve says. Forget about these takeovers, in Twitter, in Robinhood, and forget about what the CEO of DKNG says that, oh, you're going to regret this if you're shorting your stock. I'm going to make your life miserable. Okay, cool. And whenever the CEO starts defending his company against shorts, it's time to short that company, is the way it's always been. But tune out the noise as much as you can, which volume is noise to a degree. Don't wait for the volume. Base your price action. You're in this for price. If the price hits your level, take action. If it's a good plan and others see what you're seeing, congratulate yourself and say, hey, look, I'm a visionary. I'm here before everyone else. This feels good. Now watch them all come. And when it breaks out, I'm going to feed to them. When it breaks out on heavy volume, after it's rallied 8% in the last 3 days, when I bought it, as it broke above that low consolidation in the shorter term time frame. So only price pays encompasses really just tune out the noise, tune out the analysts, the CNBC, and a lot of Twitter, and myself included. I mean, if my time frame is different than yours, don't argue with me. Just move on. It's not for you. I'm going to block you if you argue anyway. But it's just, stay focused on what you do. And if you don't know, this is why you're here today. Find stuff from this seminar that I'm doing, from what Patrick did, what Denise is going to say next. She's awesome about market psychology, and all the other great speakers lined up. Take little pieces out of there and create your own method of dealing in the market. My style is unique to me, but it's also pieces of what I learned from Stan Weinstein, what I learned from Bill O'Neill, and what I learned from hundreds of people on Twitter and different books that I've read over the years. Be your own person in the market, but have it emphasized in good trading concepts, understanding of what the market is.
Perfect, Brian. I think that's a great place to leave it there.
Okay.
Thanks so much for your time, and for everybody watching, thanks so much for your excellent questions. And it's now time for lunch, so we'll be back, I believe, at about 1 o'clock for Denise Scholl. So make sure you guys tune in for that, and so we'll see you guys there. Take care.